Zoom has just released their second quarter earnings for the year, and we're going to be going through these numbers right now. The market has not been too kind so far, down there you go, just saw a change, down almost 5% after hours to $92.97 a share. Over the last year, Zoom has absolutely been hammered, down 71%, obviously down a little bit more since then, went from round about $375 a share, even lows of 80, and is now at 97. So what I'm going to be doing today is going through these latest earnings, talking about them, comparing them to previous years, and then taking this to my discounted free cash flow model and my Buffett-Graham intrinsic value model to see if this stock is a buy or a sell. So as I said before, Zoom has been hammered over the last year. If we go back to the 5-year chart, it's still higher than it was before the pandemic, before the massive shoot up. It was around about $73 a share, but we've had all these massive gains. The stock was up 665%, and since then it's down over 85%. Right, let's get into it. So we have the earnings right here. What we're going to be doing is we're going to be going straight into the statements here. And firstly, we're going to be looking at revenue. So what do we have here? We have on the right-hand side, the 3 months ended of 21, and we have the 3 months ended in July 22. So firstly, what has happened with the revenue? Well, you can see revenue is up 1.0 to 1 billion to just about 1.1, which is pretty even with analyst estimates. Actually, a little bit on the lower side. Analysts were expecting anywhere between 1.1 billion to 1.13. So this is on just, well, I suppose they didn't meet expectations, and that's the case. Next, we want to be looking at the profit, and the profit is here, net income attributable to common stockholders. And you can see it is down massively on the quarter. 316 million down to 45.7. Now the reason for this is, what is revenue? Well, cost of revenue minus everything else. We can see the cost of revenue is up slightly, but not enough to really make a dent. You can see here they've spent a lot on the research and development, up over double, and sales and marketing as well, up almost 100 million on research and development and 130 million on sales and marketing. Overall, we bring this back down. Total operating expenses 465 to 704, and then obviously everything else. This brings us to the net income at 45 million. Yes, still profitable, but if you look, it's down massively. And if you look at the 6 months here, $500 million to 159. So that is probably why we are seeing such a big dip in the share price. Analysts had expectations of about well, they had $1.16, $1.09, $1.07, 87 cents a share, and you can see obviously they've dropped down massively below that, and this is why the share price is currently being hammered in the post market. Next, we want to be looking at the shares outstanding. Are Zoom buying back their shares, or are they issuing new shares? You can see here they've issued new shares, 295 million up to 298. And why is this important? Well, if you owned 1 share of Zoom and there was 10 shares, you'd own 10%. If they issued 10 more shares, there'd be 20. Your your percentage will go down from 10 to 5. But why is this useful for a company like Zoom? Well, if we go to the 5-year chart, if they were issuing shares back here, obviously the stock price went up to $480 a share. Oh, sorry, much more, over $500 a share. Issuing shares at here, then the prices then dropped off 75%. That is great because they were issuing shares, they were getting the capital, and they have been able to do it all the way. So actually, normally I don't like them issuing more shares, but here this is obviously a great decision because the share price has been hammered. Finally, we want to look at the free cash flow, and I've just scrolled down a little bit too far there. Sorry, here we are. How do we get free cash flow? Well, cash operating activities minus capital expenditures, and here is the net cash provided by operating activities, and it is down once again. 468 million down to 257, and the capex is here. Capex is up quite a bit, almost double, 12.9 to 27. So in terms of free cash flow, you can see it's slightly over 220 million for the quarter. Now let's take this to our discounted free cash flow models and Buffett-Graham intrinsic value models. First, we'll be looking at the averages, and then we'll be evaluating the numbers to see if we think that is fair. So What does this give us? A future free cash flow value of Zoom, $300 a share. That is very, very high, but you can see here this is a very quite bullish estimate on there. So let's take a look at the numbers here. Revenue, you can see revenue has slowed down massively. Analysts are expecting between 6 and 11% over the next few years. So let's just take this down a notch and put it at around about, we'll go on the bullish side, we'll say 12%. This is the 2023 numbers analysts expecting. Next, the net income margins. I would say those net income margins are fair. Obviously, this 2018 number was a lot lower, but I think this is a fair estimate right now. And then the free cash flow net income, this number has been all over the place, but I think we need to drop that down and use the previous number. So let's take this to 103%, which is the 21 number. Then what does that give us? A fair value of $101 a share. You can see these free cash flows are a lot more in line with what we were seeing in the previous numbers. Now, I do think this is, well, the model is saying it's fairly valued, $101 a share. Obviously, it's gone down a little bit after hours, but according to these latest numbers, that's what the model is saying. Next, we want to be looking at the Buffett-Graham intrinsic value model. Well, this takes earnings per share, expected growth rate, and AAA bond yield into account. The earnings per share, as we saw, was quite low, but this we're looking at the 12 months. So earnings per share, we want to get from, oh, so I've copied the wrong field there. This is $3.99 is the earnings per share. In fact, these are backwards. I've just changed that. Expected growth rate, EPS. I've got my sheet mixed up because I was trying to edit it live. But if we look at the 5-year growth rate for Zoom, what do we see it as? Well, the analysts see it over the next 5 years of 13.58%. Obviously, I've got these numbers backwards, but it doesn't matter because it's put in the calculation. And that would give a fair value of Zoom of $224 a share and a Graham price of 181. So both of the models, surprisingly, are saying it's a buy. The reason for this is actually, let me just fix this sheet because otherwise I'll forget in a later video. So K and L, so we'll change that to K, and then K, and we'll change this one to L. Oops, a daisy, it was AL, wasn't it? I've got my tracker spreadsheet here that I've messed up because I have tried to change the Zoom fields on the fly, but we'll just quickly fix this up so that the video can continue. There we go. Doesn't make a difference. Oh no, it does actually. See, so sorry, because the way the calculation, the Buffett-Graham intrinsic value calculation does it is here. So I'm sorry about that. I thought the numbers were fine, but you can see here that the earnings per share is $3.99 based on the trailing 12 months, and the expected growth rate is there. So it's actually a fair value of $154 a share and a Graham price of 115. So interestingly enough, both of the models are saying it is a buy. And if we go to what the analysts are saying, they're saying on the high side 190, lower side 91, and average of 132. So personally, I do not think the stock is a buy. Not at this price anyway. I mean, if it decreases a bit more, I just think there's been too much instability in this. But all of the models and the analysts agree. Finally, we just want to have a quick look at the forward-looking statements. This is one thing that we have here that I don't often talk about, but we have the financial outlook here. The final for the third quarter of fiscal year, total revenue is expected between 1.095 billion and 1.1, and non-GAAP incomes operations to be expected to be 325 million and 330. Non-GAAP diluted earnings per share is expected between 82 and 83 cents, with approximately 306 million weighted average shares outstanding. For the full year, total revenue is expected to be 4.385 billion and 4.395 billion. Full fiscal year non-GAAP income operations will be 1.440 and 1.405 billion. Earnings per share $3.66 and $3.69, with approximately 307 million shares outstanding. So that is the financial outlook. And if we just quickly check, still dropping after hours, down almost 6% to $91 a share. So if you believe in the discounted free cash flow model and the Buffett-Graham intrinsic value model, this is the time to buy Zoom. But personally, I would not. Right, guys, thanks for watching. Please give a like on the video if you enjoy it, and I'll catch you guys next time.